Right, chapter 6. So we look at the conceptual framework here. In fact, I dare say this is all theory. I don't know if there are any numbers in here. I don't think so. There are no numbers in here. I mean, if there are, we'll have a look. But we're really looking at the conceptual framework, the underlying of how everything to do with financial reporting fundamentally. So again, I'll break these up into little chunks to make sure that you can bear the the drama. All right, let's go. Um, so, what are we talking about here? We're really arguing that um, every 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 body of professionals must have some kind of framework, um, set of standards that they can all adhere to and all kind of look to. It's nothing new. This is really most organizations and most countries have laws. Yes, there's nothing new here. Key point is that we have a framework of standards that we apply when so that we can, for of course standard reasons, so we can compare and so people can trust what we're doing. Anyway, let's go from the beginning. So the regulatory framework, which uses IFRS. So really, IFRS, International Financial Reporting Standards, is really the point here. We're thinking, how do we get a set of standards that we can all agree with? We can all agree with. Remember that these are just standards. So really, what you have is, of course, before you had this sort of global thing of IFRS, you'd have had, of course, individual countries would have had their own standards. They would have their own laws. I mean, depends on where you are. You might be in the EU, so already sort of areas and spaces that are working and trading together would have, if you like, directives in place. And of course, if you're listing on the stock market, there'd be rules as well. So there is really there are a lot of factors that are playing, if you like, lots of stakeholders when it comes to trying to understand these standards. Now, remember that, again, like I say, that in terms of why do we need a framework? Well, we're really trying to build a relationship or a trust with our stakeholders. And so really, the point of this is aimed at ensuring that users of financial statements receive a minimum amount of information that will enable them make meaningful decisions regarding their interest in a reporting entity. And again, like I said here, the framework is required to ensure that relevant and reliable financial reporting, again, is around to meet the needs of shareholders. So we want to make sure that people reading this, but of course, following those standard principles, those core principles of accruals, if we're all using accruals, if they're using accrual systems in Brazil, using them in Venezuela, using them in Joburg, whatever it is, we're all using the same standard so we can compare companies from one to the next. And so we can, when we see these companies on the stock market, we know they're all using the same standards. So you can see the relationships are quite multifaceted, right across, cut across, if you like, very much a global outlook to deciding or to trying to confirm this question of a framework. And again, of course, really you can set these standards up. Again, it's almost like a matter of honor, a matter of trust, if you like. But you do need some sort of legal, if you like, and market regulation to ensure people comply with these standards. I mean, you still have scenarios where there are certain standards you can choose not to apply the standard, but then you must disclose and clearly disclose, if you like, so that people know why you've chosen not to follow the standard. And so typically, again, like I say, this is very much based on this idea of the conceptual framework. So really, again, in England, we have very much, and we'll see that in a second, this idea of a conceptual framework, which is very principle based, if you like. We're sort of saying, what would a rational man do if there was a fly on the wall? How would they reflect on this? What is the substance of this transaction, as opposed to what is the legality behind this, if you like? What was the point? So accounting standards are created using the conceptual framework as a basis. You have the other option, which is a rules-based framework, where you can literally have rules for everything. You can say, listen, you can only recognize provisions over a certain amount. Contingent liabilities have to be this amount. Leases have to be this amount. You can go with the amount, but then we sort of argue conceptually in terms of leases. Are you controlling the lease? Are you controlling the asset? If you are, in substance, then you recognize it as on your statement of financial position, as opposed to saying, saying, I've actually rented the asset, I'm going to keep it for 20 years, and then I'm going to return it to the owner. But then it'd be useless by then. So, because legally they own it on paper, but really you're using it. So this is what we're really talking about when we talk about this idea of principle versus rules based. And accounting standards really are a set of rules which companies, of course, must follow from a rules-based point of view, but we don't take that approach. In the UK, there is a principles-based framework in terms of the statement of principles, and if you like, and a rules-based framework in terms of Companies Act, EU Directive, and Stock Exchange rulings. So of course we will follow whatever the rules are with, if you like, the Companies Act, because this is legal, and of course any stock exchange rules we will follow as well. Harmonization, I mean, this kind of speaks for itself. We are now in a global community. You can go into the stock market and you can see stock from Indonesia, you can see stock from China, you can see stock anywhere really from these different companies, these companies that are owned by companies right across the world. These companies are owned by are based in different countries right around the world. So it does make sense to have something that's quite uniform and works right across the board, so that you can make effective investment decisions. So really, that's really the point here. Again, like I say here, this means that if I can trust your financial statements, I'm happy to be living in whatever Accra, and I'm happy to invest my money in a company that's based in the US, because I can trust that the statement of financial position have been prepared according to certain standards, and I can trust those figures year on year in terms of their profit. And that's one of the key points. This free movement of capital is enhanced by harmonization of financial reporting. Of course, consolidation, that's the other beautiful thing. You can have a company in Ghana that owns a company in the US. And so it means that the company in Ghana, of course, can then, if you like, if they're both following the same standards, because IFRS 3 and IFRS 10 all require that the subsidiary will retranslate its assets, not just in terms of forex, but will align its policies and its standards in line with the parent. So you would be in Dutch, you have to translate from the dollar to the CD. And that's kind of the issue here. So if you're already using international financial reporting standards, hey, it's wonderful. We don't have to deal with those standard changes. There are no differences. We're using exactly the same standards. It's just a matter of currency translation. Yeah, again, like we've already highlighted some of these advantages. Investors can make decisions. If you like, financial information is consistent between different regions. If you like, tax, of course, is easier to work out. Of course, when we talk about tax from foreign entities, if you like, coming in. And so now we have, and it's just basically easier to work if we have similar accounting practices right across. We just understand each other. Of course, the problem, of course, with harmonization, of course, is that you're trying to harmonize. It's like I always think of it like you have. I'll give you a classic scenario. You have a country like Nigeria here. Nigeria is a big country, very populous. Sorry, you are. And Nigeria has over 250 different languages. Ethnically diverse country. I think it even has more. So people would, how do these people speak to each other? So people argue that we should have a lingua franca, or our lingua franca is English. Now, of course, you now have everyone speaking English, and that makes sense because we can now trade, or we think people would argue that you can trade better because you're all speaking English. But of course, think of English coming in and you already had these individual languages already there. So it's costly to kind of get everyone trained and speaking the same language. You have different legal systems because you do have different legal systems. Remember, this is a very diverse country with different legal systems in the north and different legal systems in the south, technically, and different cultural sort of nuances. So the key point here is that there are difficulties. Of course, there are advantages, but we're just highlighting that there are, of course, challenges. I wouldn't say difficulties. I would just say challenges that you have to overcome. Equally, whether a particular entity applies sometimes these are small. Sometimes we're dealing with very small companies. I've been asked several times that many of the companies, 80% of companies are small and medium-sized. So really, we're creating standards that don't really apply to many of these companies. And many of these small and medium-sized businesses are using their local financial reporting standards, and that's who they trade with. They trade with companies in their own space. And so this is not something that really worries them. They're not doing a lot of international trade per se. Right, again, I think it's good to keep these short. It's all very theoretical, so let's keep it short, and I'll carry on in the next video.